All right. Before we proceed, allow me to introduce myself first. I am Sandra. I am the Sales and Operations Director of the Philippine office of Quintigral. And I know you're all excited with our first Learning Forum series this year regarding numbers, of course, finance for non-finance executive. But before I turn you over to your facilitator, allow me to give you a very brief background of who we are and what we do. Though I know you've watched the videos already of our company profile, but it's just very quick, just to let you know who we are and what we do. Let me just share my screen. Right. Can you see my screen now? Yes, yes. Yes. Okay. Thank you. So this is our first learning forum series. This year, our free webinar. Actually, I've seen few familiar names that have been attending our webinar since last year. Thank you for always attending with Integral's webinar session. All right. So for today, it's from numbers to narratives. Actually, the AMA training programs is the finance for non-finance. Right. So before that, let me just connect it to our upcoming public program, which is the of course, financial acumen related course of AMA program, which will happen on June 9 to 10. This is a face-to-face training session. We will announce where the venue is as soon as we receive your registration. This is a 2 full day training session. Right. So allow me to introduce Quintigral Philippines. So we are a Trenocate company under a huge IT company firm from Japan. So under the umbrella of Trenocate is Quintigral that handles the leadership and management program for them. And of course, we are the exclusive partner of American Management Association, not just here in the Philippines, but also in these countries. And our headquarter is in Japan. Aside from that, these are our suite of solutions. At the heart of our organization is the American Management Association. But of course, all of the programs that we offer is under AMA, but we also customize training programs based on your needs and of course, based on the profile of the participants. And our mission is, of course, to enable people to execute global strategy. Aside from the AMA programs, we also offer assessment tool. This is the talent analytics from Chali, from our partner in the US also. This is an assessment tool that can predict the potential of an individual, and this has 85% accuracy and passed the level of Six Sigma level 5. We also have business simulation from our partner in Malaysia. This is a gamified way of learning. This is via online session, and we can also run this via face-to-face session. And of course, we have IT training from our mother company, Trenocate. We have a separate office here in the Philippines. We also have certification programs from all of these suite of solutions, plus the International Coach Federation and Project Management Institute from our sister company in Hong Kong, that's Cornerstone. Right. So this one's just zooming in with our American Management Association infographic. So we just want to let you know that 98% of the participants who attended AMA training programs said that they were able to apply the knowledge that they've gained from the training programs that we've conducted. Aside from that, we have more than 1,000 faculty resources available globally. Right. So this one is just our flexible learning formats. We follow the 4 E's Bersin spiral progression, the education, environment, experience, and execution. And then this is just a sample tracks that we offer. This is just few of the hundreds of the training programs that we offer under American Management Association. And this is one of our best sellers. When it comes to blended program structure, we also offer an end-to-end training sessions, meaning from the pre-session to the post-session, we can do that for you. If you have anyone that you think is a high potential and ready for the next level, this blended program structure will be the best way to mold them and become ready on the next level of the position. All right, so I think that's the end of my slide. Allow me to stop. Let me just stop share. So our facilitator for today is an finance expert, of course, and he is also a life coach. And he's an not just those things, but also he's an expert in data storytelling and visualization, project management, and other related topics. And he is also a leadership and management expert. So without further ado, I'll turn you over to your facilitator, Mr. Anthony Villa.
Hello, good afternoon, everyone. So, um, thank you so much for that introduction, Sandra. I'll be talking a little bit more about my background shortly. I'll just share my screen. Okay, can everyone confirm if they see my screen now? The slide. Okay, welcome to From Numbers to Narratives, Financial Literacy Reimagined for Non-Finance Executives. So, in a bit, we'll be talking about a foundational concept in finance, and I promise we'll do as little math as possible, although finance is really about the numbers. There's a reason we call them the numbers guy. But before that, let's go into some ground house rules first for this session. Since it's an online session, please keep your microphones muted unless you have a question. Uh, if there is sound coming from your microphone, you will be muted. Furthermore, if you do have a question, feel free to ask at any point in the presentation. Just raise your digital hand and I will and to get my attention, and I will call you to get your question. So this is also going to be an interactive workshop. So in a bit, we'll be showing a QR code and a link that you can open to participate interactively in the session, and let's make it fun. So about me. So my education is actually financial economics, so BS Applied Economics from De La Salle University. Uh, and my first stint in corporate was actually also with Citibank as part of the treasury reporting team. And I've handled a lot of financial reports, analysis, and I continue to do so on my freelance work now when I look at numbers and financial forecasting as well. Aside from finance, uh, I'm primarily also a consultant, a project manager, and a life coach. So I'm very interested in things that can be interconnected. So that's one of the things that I love to do. I love to research, I love to learn about new concepts and integrate them together and deliver that through collaborative or win-win outcomes for people and promote growth as well as holistic development for everyone. So, in addition to that, I also do graphics, marketing, strategy, all of these things. So today we're really going to be drawing from my financial economics, and we'll be discussing about finance for non-finance people. But before that, I'd actually like to know first, what are your learning expectations today? So this will be our interactive tool today. You can open the website here, AHA Slides, with this code or scan the QR code on your phone. And please don't close that window after you're done because we'll be visiting this again and again later for questions and quizzes. So first, can I please ask everyone to get their phones or maybe their laptops and open this website displayed here, and I think the link will also be sent in the chat. So, can you share for about 2 minutes what are your learning expectations today so that we can also understand? Okay, so I see financial analysis, interpreting data in one day. Okay, what else? Risk. We'll definitely be talking about the concept of risk, and that's actually very foundational in finance. Visualizing financial data, presentation, explaining the numbers, business finance. So I'm seeing that a lot of these things are already the applied concepts of finance and how we use it in the day to day. So in one more minute, I'll be proceeding with the roadmap of the full program and as well as what our expectations are for this afternoon for this specific session. I love it. Okay, financial approaches. Benefits, yes. How do we understand the benefits, or how do we see returns from a financial perspective? The story related to numbers, yes. There's always a story to tell. We'll touch on that today as well a little bit. Okay. So now that we've gathered this, thank you so much for that. We'll be proceeding. Please don't close that window yet. We'll be using it for a few more slides later. Okay, so let's get to the roadmap uh, of the financial program from Quintegro. So the full roadmap actually discusses a lot of those concepts and learning expectations that we have. So this includes understanding risk, the benefits as well as the return, um, how to read and analyze a financial report, um, time value of capital, understanding bookkeeping, accounting. All of these things will be covered in the full program. However, today we'll be focusing on the first one, which is understanding risk and return. So our objectives today is to understand exactly what in finance is risk, what does that mean in finance, as well as what is return as understood by financial executives. Next is how risk affects the demanded return, and understand the difference, the core differences between what is finance and what is accounting. Okay, so before we get started on the lecture, let's have a money game. Okay, here are some rules towards our money game, and we'll be using the website a while ago, AHA Slides. So here are the rules. First, we have three teams: team savings, team stocks, and team crypto. You get to choose which team you're going to join, and there's going to be 3 rounds in this game. Each team sticks to their investment type, so no switching. So you can make your choice now if you're going to go with savings, stocks, or crypto for your team, and stick with that for the rest of the game. So, how does the game go? For each round, a market outcome is going to be determined randomly, and each of those outcomes have an effect on your team, whether it's the savings, the stocks, and the crypto. So, though that means there are either returns or even losses, and they may be positive, negative, or neutral, depending on your team's risk level. So, using this app will also be gathering points for you, and the team with the highest total return wins points. So, if your team doesn't win this first game, don't worry, because later on, we also have you can also win points through the review questions and the like. So, just to give you an idea what the risk profile of each one is. So, if your team savings, you go with low risk and low return. That means steady income and the like. If your team stocks, you're after a higher return and you have a little more appetite for risk, but not too much. And lastly, you have team crypto, wherein you're very game for all of to take on more risk so that you can get more returns. Okay? So let's go back to our slide. So on your devices, you should see that you can pick your team already. I'll give you about a minute to select your teams. Okay. It's 18 out of the 24. So let's see. Let's wait for the others. Okay, so far we have 15 participants going the medium routes, team stocks, 5 participants with team savings, and 2 participants with team crypto. I'm seeing 22 already joined, already selected their teams. If you don't get to join a team right now, you'll still be able to participate in later parts of this program, of this game, or of the program. Okay. Yeah, so 24, 25. I think that's good. That last person, maybe you want to make up your mind already in 3, 2, One. Okay, let's go. So six people for savings, 15 stocks, and three crypto. So how are we gonna determine market outcomes? We're gonna do it randomly with this spin wheel. So each of these six outcomes has different effects on your team, and we'll be recording each one random first, and then we're going to switch to a sheet that shows the effects on your portfolio. Let's call it that already. Okay, so for the first round, what's going to happen? Let's see. Volatile fluctuation. So in the market, sometimes erratic things happen that cause volatile fluctuations. What can these be in the real world? Sometimes it's war. Sometimes it's unpredictable policies, like what's happening in the United States with tariffs. So these volatile fluctuations cannot be predicted and cannot be prepared for. It's kind of like an earthquake. So let's remove that so it doesn't happen again. And let's see what happens in the second round. We'll show the specific effects on each team after the three rounds. Okay? So what happens? What might be round two about? What's the next part of your story? Tech crash. So what's a tech crash, or what might happen in a tech crash? So this is like a situation where your biggest companies are invested in technology, like in the United States, for example, and all of them collectively crash or a bubble burst. So the last time this happened was back in 2000s, the early 2000s, in the dot-com bubble. For example, at the time, a lot of people were investing in companies. At the time, also now modern day startups uh, that were websites. That's why it was the dot-com bubble. So there were so many people interested in investing in the new dot-com website or whatever until all of these got inflated. And when the bubble burst, the market came crashing. So how might that affect things like your crypto or stocks now? Let's see. We'll show that in the next slide. And then let's remove this entry so it doesn't happen again. And then the last one, what might it be? Medyo sad. This economy is kind of sad, actually. Volatile and crash. But we have a happy ending, market boom. So what happens in a market boom? So this is when we see that a lot of people have jobs, a lot of employment, um, positive news from the stock market. Businesses are making money, or they're creating new record profits. Moreover, that also means like overall, like your economy is just progressing. Like people are happy, there's income, there's savings and investment. So I'll switch quickly to the Google Sheets so that we can study what happened or what happened to your portfolio. Okay, so the first one was a volatile fluctuation. The second was a tech crash. And finally, it was a market boom. So based on this result, oh wow, it's actually the team stocks that won the most points. And Team Crypto actually lost $300. So let's go at these example outcomes one at a time so that you can get a bit more understanding how it works. So first, in the volatile fluctuation, or rather, let's just analyze it per team. So if you look at savings, the savings, it accumulates the smallest amount of income, $50, but it does it consistently regardless of what's happening in the market. Savings isn't the only kind of um, product that does this. There are other things like bonds, which I can share more about later. But savings and bonds, they're generally low risk, but also low return. So as you can see, despite the different kinds of events or outcomes in the market, you're getting a consistent return on your investment or income rather, except when, for example, here the most extreme one, cut rate cuts. This doesn't frequently happen in the Philippines, but this means interest rates get lower, so that makes your income less your savings less profitable. So this is more evident in, for example, the US or the Fed. How about stocks? So stocks, as you can see, there's a medium change or variability or difference among different outcomes here. So during a recession, most businesses hold back on their spending because they're afraid of putting money at risk. So that usually results in a shrinkage of values in stocks, also decreased productivity and performance. That's why uh, it registers as a loss. For example, however, in a stable economy, not necessarily boom, but things are going well and steady. Businesses grow, and so does their stocks. So this represents what would be an average or reliable way of earning income. However, we understand that the market isn't always stable. It's not always very steady. Sometimes it goes boom and you see your stocks growing faster than usual. Or like in the dot-com crash or the financial recession of previous years, your stocks might fall because other sectors are falling, like in tech. Here, volatile, it's simply a random thing. Sometimes stocks may or may not be affected by specific sectors. Sometimes central banks, when they cut rates, lower interest rates means um, corporations that are in the stock market, they can borrow money to reinvest and expand their operations and they grow. So although that means your savings gets slower, that might mean that the companies you've invested stocks in that you have stocks in they can borrow more money cheaply and they can grow. So here with crypto, in the real world, it's much more volatile. But here, when a recession hits, it hits harder on crypto. When the market is booming, they enjoy much more returns. But due to random events like volatile fluctuations, or when, for example, the companies backing that crypto asset suddenly disappear or suddenly fall, you can lose everything that you've invested through crypto because it's high risk. It's really high risk. But the highest chance of earning is also there, or the highest return is possible here as well. So that's our game. We'll be able to record actually who joined team stocks. I know at least 15 people got to join team stocks. So you'll be getting additional points later on. Uh there will be actually a reward for people with who will accumulate the most points throughout the presentation, and that will be a discount voucher for the paid program. For more details, you can reach out to the other Quinty Girl team members such as Sandra. Okay, so that was our game. Uh Let's continue with our session today. So, how was that for you? You can look back at your device and maybe you can share with before we start with the hard lessons already. What did you appreciate most from that simple game? You can share here ROI. Yeah, so different that's the reality of the market. Finance, it's making an ROI out of the different kinds of outcomes that happen in the market. And most of the time, we don't have control. What else? Investment strategy. What kind of investment strategy might that be? Um, Sometimes in real life, you're not limited to just one instrument. These are called instruments, by the way. It means you can mix and match. You can have more money in savings, or you can have money in stocks. So that's really one way to strategize how you can manage it. Yes, low risk safety, but low ROI, but you don't lose your money. Medium, maybe best of both. Yes, that's true. That's true. Managing risk, reality, and risk. Analytical figures. Yes. So, most of the time, a lot of financial news is thinking about what's going on now and how it will affect the future. And because you have to make decisions for the future as well. Impact from current events. Yes, it's true. So, risk-based decisions. All finance is actually risk-based decisions because we're dealing with the future. I'll show more about that later. How decision making is actually made when you're dealing with unknowns, literally the future. You can't know the future unless you have a magic crystal ball, which we don't endorse in finance either. What else? Risk benefits, the concepts of risk. Okay, I love this so far. So, let's continue and let's discuss first some key concepts in finance and understanding risk and return. And of course, the most important concept in finance is the concept of money. Is my screen sharing properly? I think it's not. Let me just restart that. Do you see my slides again now? Okay, thank you, thank you. Okay, so just to go back, this is what we've appreciated from that game. Now let's start with what is money. Um, Finance is two things really. It's about money and it's about risk. So what is money first? First, money is a coupon. Coupon, parang voucher, allowing the immediate purchase of goods and services. Why is it just a coupon? If you ever wondered what gives money its value, it's actually because it's a promise. It's a promise by the government that that piece of paper or that coin gives is equal to that amount. And what's that amount or what's that value? It's very relative. It depends on a lot of things, including or somebody also asked the gold standard. I'll get to that's a bit of an advanced concept, but it's not anymore the gold standard that determines the value of money because there's no more currency or there's no more money that is tied to gold. Before it used to be like that. Now it's really just the promises of all the governments. So it's the government of the Philippines, the government of the US or China. They are all making promises that money is equal to this. And we just use that to trade to buy things or to get other things that are worth the same value. It used to be tied to gold, but it's not anymore. True. It's called fiat currency. And that's exactly what that word means because it's all based on the promises. So the stability of money depends on the stability of those governments able to back up the promise. So when a government says that they have this much money and they can back it up through other ways, then that is how money works in the world now. So what about investments? Why do people invest? Why do people not just use all of their money to buy real stuff? Like for example, I have 1 million. Why would I invest part of my 1 million into the stock market or to grow it? Why not just buy all of the real things, the physical things that I can touch and that I can say has this much value? Well, it's because um physical things also deteriorate and they lose value over time. But when you invest in stocks or financial markets, your money has a chance to grow value. And when you give it to another party, like whether it's a company or you're lending it, you want to get return from it. You want to be compensated for that weight. So somebody chooses to invest their money, whether it's in a new business, it's in the stock market or anywhere else, because they want it to grow and they want it to be compensated simply for waiting. It's that exchange. Because then again, instead of lending money or investing that money, they can always use it somewhere else, right? They can just buy a vacation now. They can enjoy it now, essentially, instead of letting it grow elsewhere in the future. So, it's about being compensated for waiting for that risk as well. But are they sure that the money is going to return? Not always. So that's the concept of risk. They're not, when investors or people handling their money are not sure what will happen with their money in the future, that's the concept of risk. And because they're taking a risk, maybe they get anxious or they feel afraid. That's the more risk there is, they will always demand a bigger compensation. Why? Because if it's so much more sure that they lose all of their money, they also want to feel encouraged that if they go that way, if they, for example, you invest in that crypto, you have a chance of making it back, or it would have been worth it that you waited and risked that much. So more risk or more uncertainty, the bigger compensation an investor will demand. So if things are risky, the return should be bigger as well. That's the basic concept of money for investors as well. It's something that can buy services and goods today or that it can be grown tomorrow. And if they're going to choose to give it to somebody else or another company to grow tomorrow, they want more income depending on the risk. That's also why sometimes companies that have a proven track record in the stock market, we call them blue chips. They don't normally give higher returns anymore because it's either their growth is very stable, but at the same time, they don't have to uh, give more of their income in the form of, for example, dividends or income sharing, because they're reinvesting it to be sure as well to secure their growth. So that's money. So just a quick check in. Let's go back to our slides. So first question, and these have points, by the way. So let's wait until everyone's back. So the first question to check in here is, why do investors demand income or compensation for their money? You can input what your best understanding is. First answers, the fastest answers get higher points. And we have 10 seconds before this one is over. 3, 2, 1. Time's up. Let's see. Oh, so let's see. So the best answer would have been offset the risk of investing, profit for return. We can accept more answers actually. Let's see what all the answers were. Okay, for the weight, risk, profit, it's kind of like asking why they demand profit. It's like asking the same question, right? Return on investment, it's also not necessarily the reason why they demand it. So for return, so it's for the weight and the risk. Security is not necessarily this answer. So profit, it's not this isn't the correct answers, because asking why do we expect profit for profit, right? What's the reason to earn the profit? So it's because you wait and it's because you take a risk. Okay. So let's see our leaderboard. So like I said, we'll be collecting points in a bit. So the fastest answers also get more points. There's two more later on, so you can and if you want, if your team stocks from a while ago, you also get extra points to help you get your leg up in the leaderboard. So keep going. Okay, so that's money. That's also the reason why investors seek income for their money. Okay, now let's talk about those two concepts, risk and return. So all of the world in finance is about demanding a return. It's always about what's the return going to be, and we like to call it the ROI, or the return on investment. I'll talk about what it really means later, or what the formal explanation is. And not being sure, finally, the second part of this definition is not being sure what the return might turn out to be, risk. So you're trying to get a return from things you're not sure about. That is finance. So, first, what is risk? Or what makes something more risky as well? So, risk, the less certain you are about what the outcome will be, positive or negative, the more risk there is to the investment. So, this means that investments whose returns are less predictable or vary greatly year on year, or during every period, it doesn't have to be yearly, it can be monthly or weekly. Those are the kinds of investments we call risky. So the more that we're able to be sure about what might happen in the next period, which is could be next week, next month, or next year, about a financial instrument, that's when we say this is a low risk instrument, financial instrument. But if we really can't be sure what might happen, if things can go uh all the way positive, like positive 1000%, or all the way bad to negative 3000%, and we have no way to know, that's something considered risky. And so risk is essentially the uncertainty about the outcome. However, when we judge something to be less risky, it simply means that we're more or less 90% sure that that's what's going to happen in that scenario, or in the next period rather. So let's let's get another check in. What constitutes risk, or what is your understanding of risk? Like that. So what makes an investment risky based on our definition of risk a while ago? Okay, three, two, one. Time's up. Okay, so most of you got it right. It's the variability of income. So that is what makes the risk part of risk. Okay, it's not the amount of how big the money you're going to get, or not even how much money you're investing. It's the variability of the outcome. So you, for example, you can have a big amount of money, let's say 100 million pesos. It's a big amount, right? But if you're going to put it all in bonds, you're not necessarily in a risky situation, because more or less bonds are quite safe and you'll get your money back. So you're not taking on a lot of risk anyway. So that's the basis of also your expectation for more income as well. It's not the amount you invested, but whether you put it in a risky instrument or vehicle. So, for example, you can have something that's super sure and also say that it's going to make you a big amount of money. So low risk but high return. That's most likely too good to be true. It might be a scam, but it's also not about, it's in the theoretical sense, it's also not risky, because if you're really sure that that's something that will create that amount, then that's not risky. You're sure already. You're sure it's going to happen. So you're not really taking risk anymore, right? But in general, if something says that it's low risk but high return, it may not be real. It may be too good to be true. Because if a lot of people figure this out or find out already, they'll all be doing it already. So that's also the length of investment. Good that nobody answered this, because a lot of safe investments may take years. Some risky investments may also take years to return money. So it's not the length. It's really just the uncertainty and how, for lack of a better term, unsure you are with what's going to happen. Okay, so who's our leader now? Okay, so it's Shy. Congrats, Shy. There's one more round later. And as well as for the winners from the team stock a while ago, you're gonna get plus points. Okay. Oops, later ka pa. So, risk and return. Let me get back there. Baka nag-ano siya. Whoops. Okay, risk and return. So what about the other side of it? Return. Let's talk about returns now. And this is the part we're going to do a little bit of math in a while. Just to show you what return really means for somebody who's thinking in finance. But next is, now you understand risk, right? It's kind of when it's things are when you're handling uncertainty. So how do you make decisions about that? Well, your expected return must be high enough to compensate for your investment. This is what I was talking about a while ago in money, that investors will demand a higher expected return for the risk that they're taking. That's a constant in any investment discussion or in any finance discussion. When we're asking for money from investors or uh, anyone that provides budget, actually, they're asking for higher expected returns based on the risk of that investment. So let's do a quick study. Let's do 5 examples or a number of examples, because investors look at it from a statistical approach. And I'm going to show you we're going to do a little bit of math, and you'll be following me along as I write it. So let's do some examples first so that I can show you what I mean by a statistical approach. So let's start from the most simple kind, a coin toss, to something a little bit more complex like a business. Um, so let me just switch to another camera. So I'll be switching to my notepad. Can you see my notes? Okay, you see my notepad now. So first example, can you please give a thumbs up if you're seeing clearly my notepad right now? Okay. So in our first example, it was a coin toss. So in a coin toss, there's only two outcomes, right? A 50% win and a 50% loss. So how do I know if I'm making a good for example, if I'm gonna get a return here? Well, first, you have to consider that everything that we're doing in finance. Oh no, it's not visible. Wait, it's not visible clearly. Let me just switch my camera. There. Do you see this now? Do you see the top camera now? Okay. Sorry about that. Okay, so here we are. So with the coin toss example going back, there's really only two possibilities, right? It's there's only 50-50. So you either win or you lose. So how do you know if you're making a good gamble on this? Well, right now, you can't exactly because there's no reward and there's no investment yet. So what if, for example, we do one bet or gamble? Let's make our first gamble plus 100 pesos if heads and negative 100 pesos. You lose the 100 pesos if it's tails. So same outcomes, right? So it's oh sorry, same risk, same difference. It's 50-50, right? Uh 50-50 that I get plus 100, that I make an extra 100, or equal chance that I make um negative 100. So what does an investor think about now? So it's not just about risk appetite, but there's also math to this. Some people they say, okay, that's a good, I'll take it kasi there's a 50% chance pala. But there's also 50% na mawalan ka or that you lose the 100. So how do you make sense of this mathematically in the statistical approach of investors? What you do is that you take the probability or the chance, let's just say the chance muna. But what I mean is the probability of the first scenario happening, 50% times the expected outcome of your the expected outcome uh of that of that win of heads. So let's say the win is heads. So I'll just write it down first like this. So 50% times 100. And then I'll add it to the second one. So plus, so again, 50% loss times the negative 100. 50% times, let's just do that, negative 100. So this means the expected return is 0. So if I just do the math here, it's equal to 50 and negative 50 pesos. So if I sum up all of the possible income here, it's just 0. So for an investor, it's not worth it to play this game or play this gamble because um the it's I'll either lose or I'll either win. It's not worth it. It's not worth risking it for because my expected return is too low. So what if the game, again, all of these are games and gambles. So what if your game was well, how about you win 100 if it's heads, but you don't lose anything if it's tails. So now you have a 50% chance, which means 50% chance of winning your 100 pesos. So your expected return is now 50. So since this is 0, so 50% of 0 is still 0, right? You don't lose anything. So if your expected return is 50, you take the gamble. You take this game because, hey, nothing to lose, right? And in most realities, as you'll see later, sometimes it's a balancing act between how big the expected income or the reward is versus how much you're going to invest or the price you pay for the game. So that's a coin toss. Clear so far? Can I please get thumbs up for if people are understanding this concept here before I move to other types of games? Okay, okay. So that's a coin toss. And this is the overall intuition of the statistical approach that investors think about when they think about expected returns. So again, going back to the principle, the expected return must be high enough to 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 account for the risk being taken. So that's a coin toss. How about a bet? So here's a bet. 10% chance na you're going to win and you're going to win big. And then 90% chance that you lose small. So what does this mean? Um, if you lose small, it's because you're just losing a small amount of your bet. Like if you place a bet on a game, that's all you lose, right? And then if you win, you win big. So normally this happens in betting odds, gambling. It's actually the model of gambling, or other types of games like this. So just for example, let's come up with some sample numbers for our game. If you bet, for example, your bet is 100 pesos, and then you have a 10% chance of turning that into, let's make this the reward, 800 pesos, just for example, if the team or your bet wins. So if you win, you get 800. So let's do that computation again that we did a while ago with a coin toss. First is the probability of the first event, which is this time 10% you win, right? So let's just write this down. Win. So 10% times your reward if you win, right? And that is 800 pesos. I'm just gonna put the amount here already so it's faster. So your expected return here is 80. And then what if you lose? So you're likely to lose 90% chance. 90% chance of losing, right? Times the bet. That's all you're going to lose. You're not gonna lose extra anymore. So let's times 100. So that expected loss now, in this case, it's a loss. Your expected loss is, sorry, negative 100. Your expected loss is now 90%, so negative 90. So here in this game, your expected return is 10%, negative 10 pesos, 10 pesos, which means this is a bad game to play. Why? Because you're more likely to just lose your 100. The chances or the risk of you winning it is too low. So based on math alone, based on these probabilities alone, the reward, the 800 pesos reward is too small. It's too small to justify betting 100. It has to be a higher. This is what I mean. This reward, the expected return has to be higher, at least zero. In reality, most gambles being done, yeah, these are gambles being done with money and finance. They have an expected return of zero. Why? What does that mean? It's kind of like the coin toss. It's the fair bet. It's the fairest bet you can do. Because for bets or for games that have the positive expected return, everyone will do it. It means it's not a realistic thing to expect that there are games like that out there, right? So when we say expected return zero, it means the reward is high enough to offset this bet, to offset the bet of 100. So how much might be enough if for a reward to justify this bet? Let's see. If it were 1,000 pesos, would it be enough already? Let's just write it here on the second scenario, number two. So the reward is higher. Let's do 1,000. So sometimes, like in promotions of casinos, they increase the appearance of the reward. So you throw in a car or whatever. In business, it's like that as well. You look into what possible reward can increase. How can we increase the possible expected return? We'll show that in the business part as well. So if it's 1,000, just for example, so you win, 10% times your 1,000 gives you 100 peso expected return. And then uh, your loss, 90% chance of happening times your negative 100 pesos your bet, which gives you negative 90. So now it's already too high, right? So or rather, it's a good game, it's a good bet to take, but also unrealistic again. So most often than not, when the expected return is zero, that means that the promised return or the promised reward of that game is high enough to offset the risk. So we're actually at almost at four, or we are at four. But I'll do a quick example on business before we proceed. But so far, is the logic behind statistics, the statistical approach of investors clear already? Or do we have questions before I proceed? And since we're only scheduled until 4, do I have everyone's permission to extend a little bit just so we can finish the other topics? Okay, okay. So let's go to straight to the business case now. So in a business case like this, uh, same thing, same logic that you're thinking about. You might invest 100,000 and there's one third chance that you'll double the investment, which means you take home, you get your 100,000 and you get another 100,000 back. So your income is expected return is 100,000 and two thirds that you'll become bankrupt. If it's you become bankrupt, it's actually uh negative 100,000 because that means the company you invested in will never return your money now. So, using that same logic, one third it's like 33.33%, and two thirds is that 66.67%. I'll just write a little bit faster. So, let's say win and lose times double your investment, which is getting 100,000 back, times losing it minus 100,000. So if as you're doing this math, you're already seeing that even if your income doubles, but there's only 33% chance that it happens, it might not be a good enough reward to invest in that business. Because as you'll see, let me just get the trusty calculator. 33% times 100,000. Let's say that's about 33,000 roughly, and minus 67,000, which puts your expected return at negative 33. So from that statistical perspective of I'm not even sure if I did that right, I just did that mentally. From this, you're looking at what you're seeing is even if your investment doubles, that's not enough to compensate for the risk. And this enforces that idea that the expected return must compensate for the risk. Okay. So let's switch back to our slides. So let's do a quick review. Based on the games that we've played so far and that discussion about how investors think about expected returns, what let's do a quick check-in and match instruments depending to their relationship with their risk and returns. And this will be our final check-in as well. So are you back on your devices, guys? So looks like only two people got to answer. Okay. So going back, the relationship between of each investment type or instrument with the characteristics, this is correct. So a savings account, generally low returns, but it's also very low risk and you're very safe with your money. This is because banks are also insured, and the nature of the financial industry is that banks are protected through insurance as well as the support of the financial system so that they don't lose all of your money in the best case scenario. Real estate can present high returns. We skip the example on real estate, but it depends on the choices that a person makes about their properties. So a real estate investment can be high return over a long period of time. Not necessarily in a short period like 3 years at least. You're talking 5 to 10 years, and it may represent a high return. But it's also not high risk because it's not necessarily the instability of its price or value, but it's because of how long you're waiting. The things that make a real estate a low return or possibly a poor investment is when you choose to do other things that aren't related to it or that will not add value to it. For example, you're doing renovations that are not needed or incurring expenses or even other costs that are not related to it. That's why it may not be a high return. Bonds, again, not necessarily low return, but lower risk. This is because bonds are like loans from companies or even the government that are promises to pay. So whether or not whatever happens in the market, the companies that issue bonds as well as the government when it issues bonds, they're contractually obligated to give that amount back. So it's a very low risk instrument, but slightly higher returns than a savings account. However, it's very possible though that in the worst case scenario, that company that issued that bond is gone, that they will not be able to fulfill that obligation anymore. So again, it's not necessarily that it's not within the realm of possibilities that a bond will never be paid back. But it may happen, but it's unlikely. And then stocks, again, high risk because unless you fully understand what's going on in the market with those companies and their behaviors or the behavior of their stock specifically, this may present a high risk for you because you may not know what the best options are. For example, one company today can be performing very well, but in 3 years can disappear. And these can even happen to big companies, especially in tech. And it has happened before. Companies like BlackBerry or Blockbuster or even Nokia. Those were very big, stable, reliable companies. But because of the changes in the industry, they lost everything. So certainly, these are this is also the present risk of any stocks that we are seeing right now. Okay. So let's have our final leaderboard. And then Um, we'll go back to those who joined team. Congrats, Sai, at 82 points. So the Quintegral team will be reaching out to the top points winners. We'll also be adding the winners from the team stocks. We'll be adding points to them. So let's see who gets other points as well. So congrats, Sai. That's it for our final leaderboard. So finally, ROI. It's a percent. Just to go back and uh discuss. Yeah, we are at what time is it? 10, almost 10 minutes. 5 more minutes and we're done. We did start a bit late. So, what is ROI? So, it is a computation actually. So, it's a computation of the income you receive versus divided by the amount you invested. So, let's just go by 100 pesos here. If you invest 100 pesos and then at the end of that period, which is usually annual, you have 120 pesos na from that instrument. What's the income? Is it the 120 or the 20? It's the 20 because your 100 was yours. What you earned was the 20 pesos, right? So that means you're going to divide that 20 pesos by 100, which means 20%. That is your return of investment. It's normally a percentage. So when we say return on investment already, it means that it's not 0%. You got something like 10% or 5% already. So remember, it's not the final amount of your investment or the final balance, but what was added after the period. So if you started with, again, going back to that 100 peso example, you started with just 100 pesos and then you ended with 150. Your ROI is based on that additional 50 pesos. It's your income. And that is the basis of that ROI equation, which gives you 50%. Okay. Next, before we wrap this up, let's discuss quickly what is the differences between finance and accounting, since um, interrelated but very different. So finance is the analysis of an arrangement will provide a return. So again, thinking about risk, thinking about returns. The math that we were doing earlier, I usually accountants are more focused on entries and bookkeeping, which we'll discuss uh, in future modules. Finally, accounting is a subheading of finance. Business arrangements, entities, they have a uniform system to calculate and report the profit to enable the return. So accounting is very, very, very important in finance because this is a very organized set of rules and policies about how to record financial transactions. What's a financial transaction? Anything that involves money being exchanged for goods and services or other money is a financial transaction. And accounting takes it very seriously how to categorize them properly so that you're putting them in the correct books so that when you review them later on, you're seeing an accurate picture how much money you made and how much money was spent by your company or by the company, for example. So accounting is about tracking and reporting. Finance is about the analysis of those reports and the decision making that leads to those kinds of reports. Okay, so the main financial statements, which we'll cover in the future modules, are three things. First is the balance sheet, or in more sophisticated circles, we already call it the statement of financial position, the income statement, and the cash flow statement. So, um, the balance sheet is like a picture. So if you have a child that's growing, a balance sheet is like a picture of them every time during their birthday. So you see the changes of that person year on year. That's kind of like what it is for a company. That's what the balance sheet or the statement of financial position is. It talks about the assets of the company, its payables, as well as its current value. So it's kind of like its height if you're comparing it to a toddler. So what's an income statement? So an income statement is a story. It's the story about um what changes happened that led to the growth or the decline. The amount of income that you earned versus the amount of income or sorry, amount of money that was used in expenses. What about a cash flow statement? Well, it's a specific statement related to, well, cash. Why? Because cash is the most used instrument of any businesses. All businesses review how was cash used in its operations. So it's kind of similar to an income statement, wherein an income statement talks about how much money you made or you spent rather. The cash flow statement talks about how you were using money during that year. So, for example, cash went into operating expenses or investment activities and the like. So, you will clearly delve into that in the future installments of this program. And again, the winners of our points, the top points winners from our games, will actually be able to get a discount voucher. So, let's have a quick Q&A before we wrap up. So, please go back to your devices. So, no more points for the Q&A. So, let's just take this time to get any questions before we end the session. So, you can use the AHA slide there for your questions, or use the chat here, or open your microphone or raise your hand, whichever is most convenient for you. So based on the time now, we are at exactly at 4:15. I think we'll be done in 5 minutes. So let's give this maybe 2 minutes for questions coming in. Yeah, I think we can proceed. Sandra, we're good. Um, so today, that was understanding the basic concepts of risk and returns in finance. The next module will already be discussing about understanding the principles of bookkeeping and accounting. Not necessarily we're going to be CPAs, but we're going to understand a lot of the things that go in the mind of a CPA so that we can relate to them better as well. And of course, all of the things that we've talked about or that we expect out of finance, like financial analysis, understanding what these numbers mean, and the storytelling, most importantly, these are all covered in Numbers to Narratives, the full public program from Quintegral. So I think before that, for those interested, we also have our sign up link here today. And we'll also be reaching out to the top to the participants with the top points for their vouchers for this program. So if there are any questions, I'll still be seeing them here in the chat, not anymore in the Q&A of the AHA slides. Other than that, thank you so much, everyone, and good afternoon.
Sir Anthony, thank you, no, for delivering this workshop. Napaka-ano, who says na boring ang finance? Hindi ako na-bored. Yeah. So,
Wow. Thank you.
participants, if you want to learn more about our AMA's finance workshop for non-finance executives in a gamified, not boring session, you may sign up now. Just scan the QR code or reach out to us or to our solution at quintegral.com, or you may visit our website also, www.quintegral.com. Right. Thank you so much.
Thank you, everyone. Have a great day.